Good afternoon, everybody, and thanks for joining us today. We hope you all had a nice evening yesterday with your special Valentine and wanted to thank you for taking time out of your day today to join our team as we update you on some important financial topics. Before we get started today, just a couple of technology tips. First, we want to make sure you're viewing this today in full screen. So if you can start by clicking on the small icon in the top right-hand corner of your Zoom window, that'll show a drop-down menu. And on that drop-down menu, if you can please click on Standard at the top, and at the bottom, click on Full Screen. And that should make this full screen for you. Second, we want to make sure this is really interactive today. Most of you, I think, have been on a webinar with us before, so you kind of know how the drill works. We've muted everyone's background so that you can't just ask questions verbally. Hopefully that'll keep the background noise to a minimum. But we do want you, and we want to encourage you to ask questions. So the way you'll do that is if you roll your mouse over the bottom of your Zoom window, you'll see at the bottom the chat icon. And what we'll ask you to do is just go ahead and click on that chat icon and type your question in. And then what we'll do is we'll stop at several different points throughout the webinar to answer questions. So before we get started, just a quick disclosure. We want to remind everyone here that we will be discussing performance today. And just a reminder that past performance is no guarantee of future results. So we have a number of members of our advisor team that will be sharing with you today. And our focus today is going to be on topics that either we're getting a lot of questions on as we're meeting with clients over the last couple of months, or on questions that we think or we know will grow in importance as the year goes on and we get closer to the election. First of all, just a quick update on the Aspen Capital Management team. So James, Jake, Lavia, Katie, and I will be participating in the webinar today. And Rachel is going to get us started by giving everyone an update on year-end tax documents. But before we get started, I wanted to thank our team. I regularly hear from our clients how much enjoyment they get from working with different members of our team, and I wanted to thank them. Katie will share with you later some of the success we had in 2023 in being able to help more families either prepare for their financial future or live the retirement they always wanted to. And we couldn't continue to help more families without such an exceptional team that's committed to working in our clients' best interests every day. Now, a couple of exciting announcements with respect to our team, though, is the first half of 2024 is going to be full of weddings and babies here at Aspen Capital Management. First off, both Bryn and Rachel got engaged over the Christmas holiday. Bryn will be getting married in June, and Rachel's wedding will be in July. And then also in June, James and his wife Jessica will be having their second child. So if you have an opportunity in the first half of the year, if you're communicating with them either via phone or email, please take a chance to congratulate them on their big life events that are coming up. Now, to get us started, let me hand it over to our newly engaged partner and our Director of Operations, Rachel Rant. And Rachel's going to update you on where to best locate your 2023 tax documents, given the transition of your TD Ameritrade accounts to Charles Schwab last year.
Thanks, Mike. So to start us off, most of you probably recall that this year is a little bit different with tax documents. Tax forms will be generated by both TD Ameritrade and Charles Schwab for 2023. So the portion of the year where there was account activity at TD Ameritrade will be captured in a TD Ameritrade 1099, and the portion of the year where activity was captured by Charles Schwab will be in a Charles Schwab 1099. So, an important thing to know about this is that both versions can be found under your Schwab Alliance login or your Aspen Capital client portal. So your TD Ameritrade 1099 and your Charles Schwab 1099 will both be in Schwab Alliance and both be in the Aspen Capital client portal. So if you've opted for paper statements, both versions of the tax forms will be mailed to you. But regardless, you're able to find them online once they are released. And as usual, we do recommend waiting until the second round of corrections is released, which should be in about early March, to file your taxes. So I wanted to take this opportunity to highlight our tutorial library for you. This is a resource on our website. Let me open it. Go. So on our website, on the top bar, there's a resources button, and if the dropdown includes a tutorial library. I'll just show you a couple of resources we have in order to be able to access tax documents and other questions you might have. So the first part of this page is dedicated to our Aspen Capital client portal. And as you can see under the extra resources header, there is a video on how to obtain your 1099 from your Aspen client portal. If you continue to scroll down, there's a Charles Schwab section. And under the accessing forms and account history, there's also a PDF on how to access your account statements and tax forms on the Schwab Alliance website. And a few other tutorials I wanted to highlight. We get a few common questions. And so the first one is how to give a family member viewing access to see your accounts at Schwab. We have a video here that walks you through how to do that. Then we also tend to receive questions about e-authorization. This is a new feature at Schwab that it wasn't offered at TD Ameritrade. And this is often used for different account updates or money movements. And so if you have any questions about how e-authorization works, this is a super helpful video. And then lastly, I wanted to highlight that we have a PDF on how to check your account cash balance at Schwab. So a fair few clients tend to reach out wondering what their cash balance is. We're always happy to provide you with that information, but you are able to check it yourself, and this PDF walks you through that as well.
Hey, Rach, a question that I get a lot from clients is related to giving family members access to view their accounts. Walk people through where that's most applicable.
So that would be if you are spouses and you each have accounts that are only under your name. So for example, if each spouse has an IRA, maybe spouse A has an IRA and a Roth IRA at Schwab, and spouse B has an IRA at Schwab. When you log into your Schwab Alliance credentials, those are going to be separate based on Social Security number. So if you would like your spouse to be able to view your accounts that are in your name only, you need to provide viewing access via the Schwab website. And that's what this video walks you through.
Yeah, that's great. That one's been really useful as we've made the transition. A lot of people were set up for that at TD Ameritrade so that they could view all of the household accounts under one login. And this is going to be how they'll get that done now that we've moved to Schwab.
Yep, it is helpful. So I just wanted to walk through a couple of features of the tutorial library and provide that information via tax forms. With that, I'm going to hand it off to Katie and Livia to talk about market expectations versus reality.
Great, thanks, Rachel. Hi, everyone. It's so good to be with you today. Livia and I are excited to start our conversation today by reviewing 2023 together. Specifically looking at the expectations investors and market experts had at the beginning of the year versus what actually happened. So Livia, take us back to the beginning of 2023. What do you remember about the start of the year?
Well, Katie, we were chatting about this earlier, and I remember pretty vividly that we started 2023 out with fears about inflation, a lot of concerns about interest rates, and many predictions, dare I say, promises of a surefire recession looming on the horizon.
Yeah, exactly. Olivia, you're right. Going back to the beginning of 2023 and the true market sentiment of the year ahead, there was a lot of uncertainty. We had just finished 2022, which was the worst bond market on the record and the 7th worst equity market on record. And not only were investors fearful, but market strategists, economists, and experts were very bearish too. So let's review and start with the economists and their projections of the year ahead. Would there be a recession? So what I've done here is I've snipped a headline from CNBC Money, and you can see it was December 23rd of 2022. So it was the year right before the year had started. And the headline is why everyone thinks a recession is coming in 2023. And then I've kind of put some key points here, but mostly I'd like to draw your attention to this last bullet point where it says, usually recessions sneak up on us. CEOs never talk about recessions. Now it seems CEOs are falling over themselves to say we're falling into a recession. Every person on TV says recession. Every economist says recession. I've never seen anything like it. So if we actually go to the poll here, so this, what you're looking at is economists polled by Reuters. And you can kind of see at the end of 2022, we saw the highest, about 65% of economists thought there would be a recession in the next year. 65%. So that's like almost 2/3 of economists polled thought there would be a recession coming. And did we ever see that recession? No, we didn't. We did not see a recession in 2023. Okay, so economists didn't get that one right. We didn't predict what was going to happen in the economy. Do you think we did a better a job at predicting what was going to happen in the stock market? Well, I'll give you a hint. Warren Buffett has a great quote that goes something like, tell me exactly what will happen in the economy, and I still couldn't tell you what was going to happen in markets. And the same was true. So I just want to focus your eyes on 2023 here, and then I'll reveal kind of what happened before 2023. But what you're looking at right now is the S&P 500 estimates by market strategists versus the S&P 500 actual returns. The blue bar is showing what industry experts estimated the S&P 500 to return, and the orange bar is the actual return of the S&P 500. So in 2023, as you can see, market strategists estimated a 6.8% return. This data is through the end of November. At that time, the S&P 500 was up 19%. By the end of the year, though, the S&P 500 ended up more than 20%. So the delta was an underestimate of more than 14% by the end of the year. And this deviation from expectation happens over and over again. So let's look at the years before 2023. Now you can read the rest of the graph and you can kind of see how terrible market strategists are at predicting what's going to happen in the market. 2022, there was a 21% overestimate. In 2021, market strategists thought there would be a mediocre return, 1.2%, but we saw almost 27% return in the S&P 500, and so on and so forth. So this just goes to show you it's very hard to predict what will happen in each unique year and the unique events and the outcomes within it. So if we can't forecast what will happen in markets and we can't predict what will happen in the economy, maybe we can predict something like interest rates. And we get this kind of a lot because the Fed has 8 scheduled meetings a year, and they're so communicative about interest rates and what their plans are for them. So can we determine what interest rates might do, even in the short term, to pursue a better investment experience? Well, let's check out the data. Here you're seeing investors are almost always wrong about the Fed too. We can't get it right. So the black line is the effective rate. This is what you're looking at. What you're looking at here is the actual federal funds rate. The blue are all the expectations. So if you're looking down here at 2009, 2010, the federal funds rate just severely came down. I mean, a very big decline in the federal funds rate. And then in 2009, 2010, all of this blue line is saying the market expected interest rates to go back up quickly. But if you would have believed that to be true, you would have thought that interest rates were going to go up 2000, 2010, but it took another basically 6 years for interest rates to rise. Then we had, interest rates go up, and in about 2019, the market, so look at that blue, is saying, oh, we think that interest rates are going to continue to go up. And there was another severe decline, or interest rates came down very, very quickly because of COVID. Nobody expected that, right? And then you've seen most recently this very quick rise in interest rates. And we really saw that in 2022. And along that, the market was saying interest rates have got to come back down. And as Livia alluded to, at the beginning of 2023, a lot of people thought interest rates would come back down. But interest rates continue to rise and kind of stabilize by the end of the year. So what is all this data telling us? Frankly, it's telling us we just can't predict this stuff. Even the best financial prognosticators can't do it. Not the market, not the economy, not interest rates, not inflation. They got it wrong last year and the years before. Okay, so we know what didn't happen last year, Livia. What did happen? Can you tell us what you kind of see on this graph, Livia?
Well, Katie, if I take a look at those short-term events, I see 4 interest rate increases. I see a regional bank crisis. But if I zoom out and I look at the big picture, you really see that the patient, disciplined investors saw their wealth appreciate handsomely, and they ended the year wealthier than they started.
Yeah, that's exactly right. The market gave the patient investor a handsome return. Last year was the perfect example of how to have a better investment experience. The market was very volatile with many unique events throughout it. But the disciplined long-term investor that stayed invested through the volatility was wealthier at the end of the year because of it. There's a great quote by Voltaire. He says, "History never repeats itself, but man always does." What he's alluding to here is human behavior. We can't control markets, but we can control our own behavior. We know we'll see more bear markets in the future. We know we'll see more bull markets too. And our job, partnering with you as your advisor, is to help you put the odds in your favor by focusing on staying disciplined and intentional in your investment strategy and not making guesses on what we think might happen in the day-to-day or year-to-year game of volatile markets. So, Livia, I just want to end my section here by talking about this. Now, I thought this was interesting. This was a study done by Fidelity Investments, where they interviewed a subset of people that worked with advisors, trying to figure out and find what the true value of partnering with an advisor was for that investor. And what they found was it's not just about portfolio management anymore, or managing the money. It's about understanding what it's all for and partnering with you, our clients, to set the right goals for today and tomorrow, and viewing market performance not through the lens of each individual year, but through the lens of putting the odds in your favor to compound your wealth over time, so you can hit the goals that are important to you and your family. And in combination with that, really providing data along the way to create peace of mind, so you don't have to feel stressed about the market ups and the market downs. So as we look to 2024, it's likely to be a stressful year and an emotional year, and it'll be our role to partner with you, our clients, to not only manage your money, but to focus on helping you meet your goals and working with you to help achieve peace of mind in what is likely to be a really tumultuous year, Livia.
Yeah, Katie, you're so right. Peace of mind and fulfillment are 2 invaluable things that we as advisors provide to our clients. And you're right, we just can't predict in advance what is going to happen with interest rates, or when recessions or bear markets are going to show up, or even the actual returns. Which begs the question, what about an election year? This is really the elephant in the room right now, correct? As always, the media will do everything they can to stir up our emotions and irrational decision-making.
So, Livia, I guess as we're talking about elections here, are there any patterns that you see, like one party or the other? Do you find some patterns in the data?
Well, the big picture really shows that the market is agnostic across presidencies. Most elections haven't produced extreme returns in one direction or the other. There have been 24 elections since 1926, which is reflected in this chart. If we break this down, we see 20 of these election years have been positive and only 4 have been negative. That is to say, the annual returns were positive in 80% of the election years. So interestingly, this is in line with the bigger picture in terms of annual stock market returns since 1926 without factoring in election years. So since 1926, using the same index, 75% of the years have been positive and 25% of the years have been negative. So there isn't so much a pattern as there is a long-term trend. And that trend is that markets move up and to the right. Those who stick with their plan will achieve long-term goals. And there's really no real patterns emerge that show us what we should be doing in advance.
Well, that's interesting. So are you saying the winning party has no reliable or clear driver of the direction of market movements?
That's exactly what I'm saying. For so many people, there is a natural and understandable tendency to use elections as a prediction tool about the direction of stocks and the election winner. And this makes sense if you think about the headlines and fear mongering that comes in from all sides. But let's take a look at the returns for election years and non-election years. The data shows that election years tell us nothing meaningful in advance as it relates to the market. Most elections haven't even produced extreme results in one direction or the other. Now, each term obviously has its own volatility, and no one party has really been the subject of any more growth than the other. Election years have seen an average return of 11.6%. Non-election years aren't that far off with a 12.4% return. And really, the average of all years is 10.17%. So both segments, if we think about an election and a non-election year, have seen extreme highs and lows. And that makes sense if you think about it. This is a global economy. How realistic is it that a single candidate is going to have a material impact on your globally diversified portfolio? Like we said, the media is going to convince you that one party is better than the other. But remember, the market is forward-looking and pricing information by the nanosecond. The fact that 2024 is an election year is already known, and it has been known, just like the elections before it, as well as future elections. This is already being priced in. So the point here is if you took either side of the bet on elections, you would have left a lot of your portfolio gains on the table. The winning party just hasn't been a reliable driver for the direction or magnitude of market movements. Our advice continues to be to not react to what you can't control and instead exercise control by sticking to your plan to achieve your long-term goals.
Okay, Livia, so as we move into this election year, what are maybe 1, 2, or 3 takeaways that you want our listeners to get today that will be helpful as they go through the year?
So Katie, I think the first one is after almost a century of returns, we see that stocks have trended upward and to the right.
Mm-hmm.
I think there's also so many factors that create variation in market returns, and the US election is just one of many. Remember, the global markets have a total trading volume of $675 billion. That's a huge amount of money fluctuating, so it makes it really hard to predict anything in the short term. Think about it in more pragmatic terms. Amazon is not going to stop their deliveries because it's an election year.
Thank goodness.
Tech companies will continue to innovate, and other companies will leverage those innovations, and ultimately all companies will pursue profit through ingenuity. Again, the market prices everything in real time. Even Taylor Swift's Eras tour is going strong. People aren't changing their concert plans because it's an election year. And the third item is really that sustainable returns don't come from market timing. They come from staying in the market. Look, I would love to be able to provide sensational new data and news about what we can predict in election years as it relates to market directions and returns. But that just isn't the case. And I can really sum all of this up in one line, and that is vote with your ballot, not with your portfolio.
Yeah, that's so good, Livia. Thank you so much. Thanks for going through that. Hopefully that was helpful for us to take a minute and review 2023, how we started the year and how we finished. And maybe that'll give you some peace of mind as we move into 2024 and what is likely to be an emotional, stressful year. But the data kind of shows, and Livia's giving you some good takeaways here, of kind of how you might process 2024 as we move through the year. All right, we're going to give this over to Mike. Mike's going to take us through historical investment performance.
Thanks, Katie and Livia. Before we talk about the performance of the funds that our clients actually own, I wanted to take a step back and just remind you of some historical data. For many of you, you maybe saw this information when you were coming on board as new clients, but I think it's a great refresher. And what we're doing here is we're looking at the historical return of all US equity managers. And we're looking at their returns across 10, 15, and 20-year periods. So we're going to start, we're going to look right at the bottom at that 20-year period. And you'll see on the far right that 20 years ago, there was a little over 2,800 managers managing US equity funds. 20 years later, less than 1 in 2 of them actually survived, meaning that their fund over that 20-year period either went out of business or it was merged into another fund. So only 44% of those actually survived the period. Now, this is a highly competitive industry, so as you can imagine, you don't merge your fund or go out of business because you're good. And then finally, only 17% of those managers that started the 20-year period actually finished the period with a 20-year track record that was better than that of their benchmark index. So the important takeaway here is you only over the long term have less than a 1 in 5 chance of picking a manager that over the long term is going to outperform their benchmark index. So when we think about underperforming or outperforming a benchmark index as it relates to a manager, just remember that over the long term, it's really hard to outperform the benchmark. So now we're going to take a look at the funds that we own and their long-term, their short, mid, and long-term performance versus their benchmark index. So you'll see across the top in yellow there the different time periods from 1 year all the way to the since inception period. And let me just walk you through what you're looking at. So the purple circle designates the return for that time period of the US core equity fund that our clients own. Below that, the red circle is highlighting the performance of a benchmark index fund tracking the benchmark that most correlates with the fund that we own. And what we're using here is we're actually using a real index fund, an iShares index fund, so that we can track the return of the index less an actual mutual fund or ETF expense ratio, so that we can create a real apple-to-apple comparison. And then finally, at the bottom there is going to be the difference in performance. And if that number is red, that's a negative number, which means that the fund that our clients own underperformed that of their benchmark index fund. And if it's green, the number is green, that means that the fund outperformed its benchmark index fund for that time period. So you get the idea here that green is better than red. And as you look across this page showing all the 3 different US equity funds that we use, you'll see that on a consistent basis, certainly over the mid and long term, the funds that our clients own have pretty consistently outperformed that of their benchmark index. If we then turn to look at the other regions of the world and other asset classes that our clients own, international and emerging market equities, as well as global real estate and US bonds, we're looking at that same data. And you'll see there's a couple of data points for that 1 year period where the funds slightly underperformed their benchmark index. But as you go out to that mid and long-term period, you'll see just the same as with US equities, consistent outperformance versus the benchmark index fund. So I think there's a few key takeaways for folks as we look at this data. The first is you have to be different than the benchmark to beat the benchmark. And what that means is that we will always have short periods of both positive and negative performance versus the benchmark. Okay, so investors who want to capture the premiums that our portfolios are designed to target must have a disciplined long-term approach. And those that have maintained that disciplined long-term exposure to these areas of the market with higher expected returns have benefited nicely over the long term while they've worked with us. Now, just a reminder, if we go back to that data that we saw before, remember, historically, we've only had a 1 in 5 chance of picking a fund that would outperform its benchmark index over the long term. Yet the funds that our clients own in all 6 asset classes that we invest in have outperformed their benchmarks since the fund's inception. That's why we're happy to deal with short periods of underperformance. And in fact, we expect to have short periods of underperformance from time to time. We actually like it when there's some red over the short term on this page, because we feel like if it's always green, folks get lulled into sort of a false sense of comfort that the funds will always outperform. And in fact, that's not the case. We expect periods of short-term underperformance. And in order to get that long-term outperformance driven by tilting the portfolio to those areas of the market that have higher expected returns over the long term.
Mike, as I look at this, both on the previous slide as well as this one, focused on global markets, a lot of green numbers up there, right? And a lot of positive returns. As you look forward over the next 5-10 years, what are your thoughts?
Yeah, it's an interesting question, Jake. And interestingly, let me actually draw your attention, if you will, to this 10-year number. And on this page, if you look up and down this this table on the 10-year period, you're going to see that while each one of these asset classes had positive performance, of course, you'll notice that, Jake, that each one of those asset classes' 10-year performances is noticeably less than its long-term historic average. And in fact, when we go backwards and we look at the US equity markets, and again, we focus on this 10-year column, you'll notice that small cap equities were up 7-8%, right? That's noticeably below their historic long-term average. And in fact, of all the asset classes we invest in, only one of them, right, US and specifically US large cap equities return over the last decade was either equal to or greater than its historic long-term average. So as global investors, to answer your question, as we look forward, we think there's a lot of promise out there for the other areas of the portfolio to deliver better performance in the coming decade versus US equities, which really stole the show over the last decade.
Great. Well, we're going to transition over from talking about returns to talking about 2024 tax updates, as well as some tax updates for going beyond 2024. So give me just a minute as I get us there. The first slide we're going to cover is on those contribution and tax updates for this year. What we're going to look at beyond 2024 is a look at the upcoming sunset of the Tax Cuts and Jobs Act, which went into effect in 2017, but reverts back starting in 2026, so less than 2 years away now. But as I mentioned, we'll first touch on contribution and gifting limits for this year. We picked out 4 different areas that we think are most applicable to those of you on this conversation today, and then we'll share a table at the end which reflects other broad changes across things such as like 401ks, what new standard deduction limits are, things like that. So the first thing we wanted to touch on here is the annual gift exclusion increased to $18,000 per person in 2024. Now, remember, when I say per person, it means that any individual can gift $18,000 to an unlimited number of people without using any of their lifetime gift tax exemption. You just don't want to go over 18,000 to that one person, unless you want to use some of your lifetime exemption. So that means I could gift every person on this call or in this room with me here today, $18,000 with no need to report it to the IRS. If you're married, you can gift up to $36,000 to a single person, but just know you have to file a 1 or 2 page return with your tax return. IRA and Roth IRA contribution limits. This went up to $7,000 per person in 2024. And now remember that this is $7,000 of contributions across these 2 types of accounts, not to each one. And for those of you making contributions to another person's IRA or Roth IRA, such as your kids' accounts, this contribution will count towards your annual gift exclusion, which is that number there on the left side. And one note here is that if you're over the age of 50, you get an extra $1,000. So that limit goes to $8,000 this year. This third one we're excited about because it's the first increase in years to the amount that you can gift in the form of a qualified charitable distribution or a QCD. So that limit increased to $105,000 per IRA account owner in 2024. Remember, that's a completely tax-free withdrawal from a tax-deferred account as long as your charitable gift is to a qualified charitable organization. And it also reduces, for those of you who are taking required minimum distributions, it also reduces your RMD dollar for dollar and therefore your taxable income. So if you're over 70 and a half and you want to make charitable gifts, just make sure you're talking with us about your strategy and we'll help you through that process. As I pull up Social Security here, I'm also going to bring up the table so you can start to look at this. Remember that Social Security has received cost of living adjustment increases well above the historical average over the last couple of years. So in 2023, people receiving Social Security benefits saw an 8.7% increase to their gross benefits. And this year, that's a 3.2% increase, roughly matched to year-over-year inflation numbers. In the table below, I just encourage you to take a look at this and find what's important to you. For example, on the left-hand side, if you're working and you're contributing to a 401k and you're over the age of 50, that would be that second row down. Come over to that 2024 column and you'll notice that your max contribution limit for 2024 is $30,500. Or for example, the standard deduction for a married couple over the age of 65 down there in that green section. Right, for 2024, you'll have a standard deduction of up to $32,300. Like, as I look at this, there's one thing I wanted to come back and have you touch on that we've been having more conversations about, which is a change to both our process, our client's process, and Schwab's process in qualified charitable donations, or those QCDs.
Yeah, we've got some great changes for clients. I think we've communicated those out to folks that have done QCDs in the past. But as you might remember, in the past, if you've done a QCD, it was a fairly manual process. You had to get us information. We had to create a form that you then had to sign, and it had to be processed. And it made it slow and a little bit cumbersome, and from time to time it created some issues. With Charles Schwab, what we're moving to is we're actually just going to issue clients a checkbook on their IRA account. So there will be no more forms that they'll have to complete anymore. We'll just issue them a checkbook on their IRA account, and they'll be able to write checks directly to the nonprofit, which is going to allow them to make gifts in real time. And they're also not going to be limited to that $500 limit that we had before. So the folks that we've talked to about this, I think, are really excited about the change and just some of the freedom they're going to give them with the checkbook. I think the one thing that we just want to highlight for people, Jake, is that need to make sure that they check their cash balance in their IRA before they go write that check. Otherwise, we're going to have folks bouncing checks all over the country that they're intended to be gifts to nonprofits. But hopefully that change is going to be something that's a real win-win.
Great. As we'll continue on here, the second thing I brought up was the potential sunset of the Tax Cuts and Jobs Act at the end of 2025. So to understand this upcoming change, we first want to step back to 2017. So when then President Trump took office, he and the Congress at the time introduced the Tax Cuts and Jobs Act, which dramatically changed the tax code. And this is the same tax code we've been operating under for the last 6 years now, and will continue to operate under both for this year and next year. However, when this act was passed, it wasn't permanent. So like I said, at the end of next year, 2025, the Tax Cuts and Jobs Act is set to revert back to the tax code that was in place, at least for the most part. There are some things that won't change, but for the most part, to the tax code that was in place prior to 2017. So it's likely you're going to start to hear about this more on the news. I put up some of our favorite commentators up there, Jim Cramer, we got the Wall Street Journal. This is where you're probably going to start to hear about this first, and then you might even start to hear about it from politicians as the election cycle heats up. So we want to make sure you're informed of what we think the major changes could be here out in a couple of years. And at the same time, we want to ask you to remember that we think it's unlikely that's what is planned today is exactly how things will look in 2 years. So we'll explain the laws as they're written, but just take it all with a grain of salt. What are the big changes we're looking out for? Okay, guys, the first thing here that we're looking at is that tax brackets will revert to where they were in 2016. For most Americans, this is going to mean a slight increase in their federal income tax bracket. So each marginal rate will go up a couple percentage points in that federal income tax bracket. However, that doesn't mean your taxes are necessarily going up, because there's going to be more opportunities to itemize on your tax return. So for those of you who recall, 6-7 years ago now, you were able to itemize a number of different things that you're no longer able to on your tax returns, which could lower your taxes depending on your personal situation. A big one we wanted to call out is that the current SALT tax deduction, or the state and local tax deduction that is capped at $10,000, that deduction cap goes away in 2026. So for those of you in higher tax states, oftentimes coastal states, right, this could be a real opportunity to increase your itemized deductions on your tax return. Lastly, while the previous two changes could impact, or will impact all Americans, this change is something that will have a big impact on a relatively small number of people. And that's the 50% reduction of the current federal lifetime gift tax exemption. So prior to the Tax Cuts and Jobs Act, the exemption was about $6 million per person. It's now $13 million per person. It's actually over $13 million per person. So in 2026, that number is set to drop back down to $6 million per person, effectively reducing the amount of money you can pass from one generation to the next, free of that federal estate tax of 40%. So luckily, even at half of the current value, that's a significant amount of money you can pass out of your estate to the next generation. But just know that that is coming up as well. So to wrap up this slide and a few points here, we want you to remember that we don't think that this is exactly how things are going to look in 2 years. I'd be shocked if these 3 bullet points all remain the exact same over the next 24 months. We also want you to remember that when you start to hear about this in the news, know that the impact to you and your family is going to depend more on your personal situation than some of the generalized points that you're seeing here. And lastly, know that we're being proactive in thinking about these changes. As many of you have already seen, we're engaging in Roth conversion strategies in lower tax years. And if we think that you have an estate tax problem today, or could have an estate tax problem in the future, right, we're going to be having conversations with you, helping you connect with your estate planning attorneys and make any proactive changes you need over the next couple of years. Yes, I think this is a good place to transition this over to James, because he's going to talk about some actual specific estate plan updates. And as you think about like how and when to update your estate plan, he's got some good notes on this.
Perfect. Thanks, Jake. And before I jump into this, I'd just like to remind anyone listening that you can certainly ask any questions just by submitting to the chat on my topic or any of the topics beforehand, and we're happy to address those as well. So as Jake said, I want to just talk a little bit about estate planning, and as you've hopefully noticed by now, education is a major value of ours at Aspen Capital Management. And so whether you've never done much estate planning, or if it's just been a few years since you last looked at your will, this is a great area we think to focus on in 2024. Specifically, we would encourage everyone to check on your account beneficiaries. Do you have a primary beneficiary named? If so, do you also have a contingent beneficiary in the event that your primary beneficiary dies before you do? We would recommend that you have both primary and contingent beneficiaries named on your accounts. So checking your accounts is for your beneficiaries is such a quick and simple thing to do that it's also so easy just to put on the back burner and never do. So we would really encourage you to make sure that you go and look and check on your accounts. For any of your Schwab accounts, this is super simple to do. And if you've been on Schwab and logged in before, you might recognize this top banner here that's pretty much available no matter where you're at on the Schwab website. And so if you want to navigate to checking your beneficiaries, you want to click on this top right profile section, which will make this drop-down menu appear. And you can click on beneficiaries here. When you click on that, it should a similar page should appear where it says manage your beneficiaries, and that will allow you to see who you have named, or if you have no one named, you can name someone in this section. If you struggle to find this on your own and you'd like our help updating your beneficiaries for any of your Schwab accounts, our team can certainly help you accomplish this. It just requires you to sign a quick form. Next, if you don't already have one, you should really consider a revocable trust. They're not right for everyone, but we've seen them be beneficial for many of our clients. A revocable trust is 100% revocable and modifiable at any point in time during the grantor or the creator's lifetime. So it's a super flexible structure that can be changed as your needs change throughout your life, including updating your beneficiaries. This all changes at your death, and the terms of the trust become irrevocable and unchangeable. Setting up a trust and managing the changes over time is going to be more expensive than just having a simple will. So you might ask, why would you pay the extra money for a trust? Well, a huge benefit of a trust is the ease and simplicity for your loved ones when you die. All the assets in the trust will avoid probate, and if you've ever been through the probate process of a loved one, then you probably know it can be a super long and expensive process, especially in certain states. Also, if privacy is important to you, remember that everything that happens in probate is completely open to the public, whereas any assets that pass through a trust would maintain complete privacy. Beyond probate, a trust also allows that your accounts can continue to be managed and accessed. So without a trust, like brokerage accounts will be frozen at your death. And when that happens, not even your heirs or Aspen Capital Management can make changes to your investments. And that's something that we've seen happen before. Next, a revocable trust is a great tool to manage complexity. This could be complexity in regards to your beneficiaries, the types of assets you own, or even where you own assets. So complexity can show up in a variety of different ways, but I'll give you a few examples. Maybe you have a blended family and want to ensure that when you pass away, your spouse is taken care of, but you also want to make sure that your kids inherit your accounts at the end of your spouse's life. Maybe you have children with special needs or addictions. I think another really common one that we see is if you own real estate or other assets in several different states. For example, if you have 5 properties in 5 different states, then your heirs are going to be subject to 5 different probate processes. The simple way to avoid that is just to make sure that these properties are in a trust. But always remember, with a trust structure, you really only get this benefit for the assets and the accounts that you retitle in the name of the trust. If you end up having a trust, but you leave the assets in your own name, then they will not be subject to the trust. Wrapping up here, just want to spend a couple minutes on where you can go for help with estate planning. I think the obvious path is to work with an estate planning attorney. Working with professional expertise really makes sense for a lot of our clients. Listed on this slide are some of the primary reasons, which I just touched on, like having a blended family, or if you have assets across state lines, or even if you have serious charitable giving intentions, there's, ways to be really strategic about that. So the more complexity, the more likely that you need an attorney. because certain situations actually require a completely different type of trust, such as an irrevocable trust. And an estate attorney can help make sure that you use the right vehicles and consider variables that you wouldn't have ever thought of on your own. Now, for some of our clients, they really just have a simple situation and very straightforward needs when it comes to estate planning. For those people, using an online option could be perfectly fine. And there's actually a lot of great companies in this space, including trustandwill.com that's listed here. To choose one of these options, you need to have interest in doing it yourself with some guidance, and you certainly need to be comfortable with technology. Going with an online option will save you money, and it could really be fine for your needs. But again, this likely only makes sense if you have very simple estate needs.
Great, James. Thank you so much for that. Okay, so as we wrap up today, and before we let you go, I thought, and we thought, our team thought, that we would give you an update on the firm. Often we get asked if the firm is growing and if we're taking on new clients, and we're really happy to report that the answer is yes to both of those questions. We are growing and we are taking on new clients. A few of you might remember that Aspen Capital Management started about 22 years ago with a handful of clients. A couple of you are on the call today. Thank you for joining. And with Mike Mers running the show from an office that was literally a repurposed closet. Today, though, we're happy to report that we serve 260 families in 29 states. And we have a few international clients too. Last year alone, we welcomed 31 new families to the Aspen Capital Management family. And as we've added new clients, it's really important for us to note that we've also added to our team, as you saw earlier. We've grown from 1 to 9 full-time employees, and we're dedicated to this. We want to ensure that our level of service and our dedication to our current clients doesn't change. So looking at this map, I'd also like to take an opportunity to note that if anyone has a family or friend along the Mississippi River, we'd really love an introduction so we can start coloring some of those states in green too. Okay, well, in all seriousness, our success really is because of you all on this call. Many of you have and continue to introduce us to the people that are important to you, your colleagues and your friends and your family. And that gives us then the opportunity to touch people we would likely never have the opportunity to meet without you as the connection point. It's because of you we get to serve people across the nation, and we are so grateful. Your continued trust and confidence and all of your support throughout the years is a direct link to our success. So thank you. Last note, like we're proud of our clients and the growth of our firm, we're also very proud of our people. This year, we have 2 employees furthering their education. Nate, on your left-hand side, is sitting for his third of a 3-part test series, his CFA, which stands for Certified Financial Analyst. So he's doing that right now as we speak. We're wishing him luck, although we don't really think he needs it. And then Trevor, who's in the room right now, and no pressure, Trevor, but Trevor is currently in his CFP coursework, and he is likely to sit for his CFP exam sometime this year. So with that, thank you for being with us for 55 minutes. I'm going to give it over to Mike now and see if we had any questions come up throughout our conversation today. Mike, questions?
Yeah, we do. We do have one question. Jake, I'll let you field this. The question was around RMDs and QCDs. And the question states that they know that with some of the changes over the last few years, the dates on those two have been moving around a bit. So can you confirm for people both what the RMD age is, and then also how that links to the QCD age?
Yeah, I'm actually going to start with the QCD age, which hasn't changed, and that is continue to stay at 70 and a half. So if you're over 70 and 6 months, that's when you are eligible to start making those qualified charitable distributions from your individual retirement account or other types of retirement plans. On RMDs, that's the number that has continued to change. That's where it's got really, I guess, more complex over the last couple of years as it's changed year over year. originally, for those of you who are in your early 70s, you likely have heard this, right? RMDs did start at 70 and a half. They aligned with that QCD age a few years ago, but it's been pushed out. And so for some people, they started RMDs at 72. For people today, they're actually starting off required minimum distributions at 73. And then there's going to be another cohort of people who start their RMDs at 75. And so that's going to depend on your birth date. And that's something just so you all know, like if you're not to that age yet, we'll never let you get to that age without knowing that you have required minimum distributions coming up or that you are eligible for those QCDs. Mike, is there anything else you were thinking about there?
No, great answer.
Okay.
Thanks for those details. We did have another question. JR sent in a question asking what our total assets under management are. Katie gave a great update on the team and the growth of the number of clients. JR, I am sitting here looking at a screen right now that tells me as of yesterday's market close, our AUM was 971 million. So we're depending on the day, or certainly depending on the week, we're flirting around with that $1 billion in assets under management number, which is an important milestone for us, just given that it means as that number goes up, there are certainly more and more families that we get to help, and we've got a team here that's got a pretty strong opinion about the work we do, and that there is a better way than much in the industry proposed to do both financial planning and portfolio management, and the more opportunity we get to help people we love. So that's the number, and hopefully at some point here in the next year, we crest that $1 billion number.
Mike, while you were talking about that, another question came in of how many.
What, did that number go up while I was talking?
How many clients those assets are spread?
Oh, okay, yeah, so great. So that 971 million is spread across, if we literally updated as of last week, right at 270 households. I think it might be 269, but a pretty good number is going to be 270 households. Katie mentioned this, most of those are sort of congregated in the greater Pacific Northwest, or at least the West, but I think we cover, what'd you say, Katie, 29 different states?
29 states.
29 states. Great.
We have some clients that are soon to move to South Carolina, so I think that'll take us to 30.
That'll take us to a nice round 30, huh? Well, I think that's all the questions we had for today. Again, a thank you for hanging around, and we would encourage you, if you have any questions, either after this or as you're thinking about it in the days or the weeks to come, please feel free to reach out to your advisor. We'd be happy to set up some time and discuss things with you more in depth.